If we look at the world right now, it feels like everything is on fire between the war in the Middle East, the war in Ukraine, the energy crisis, and so on. And overall, it can feel like the world is becoming more unstable by the day. And when the world is like this, financial markets can become extremely volatile, reacting strongly to minute-by-minute developments. Because if there's one thing markets don't like, it's uncertainty. Now, of course, war is about much more than the impact on markets, considering the human suffering for those directly affected is horrendous. But also, during periods of instability, it's natural to think about what it all means for you and for the savings and investments that you've worked so hard to build. So, that's the focus of this video. Hello, I'm Brian. And today with Moneyfarm, we're going to look at how to invest when the world feels like it's on the brink of war. So, let's dive in. Let's start by saying something that might actually be reassuring. We've been here before, and we're likely to be here again. When global tensions rise, markets have a tendency to react. They don't like uncertainty, so they can plummet in response to one piece of news and then bounce back on hearing the next. And this causes investment values to swing wildly. In the early days of the Ukraine war, the S&P 500 in the US dropped around 7%, and during the 1990s Gulf War, it fell around 15%. And it's not just conflict that causes markets to become volatile. Think back to the early days of COVID, or the sharp market swings we saw when Trump's tariffs first made headlines. In the thick of it, all this is unnerving, and it can be terrifying watching investment values fall and wondering what will come next and what you should do to salvage the situation. Because market volatility is deeply unsettling, it can be incredibly tempting to react to alarming headlines. But here's the thing, knee-jerk investment decisions rarely end well. In fact, reacting to short-term noise is one of the most reliable ways to damage your long-term returns. So, before you do anything, stop, take a breath, and think it through properly. So what should you actually do when markets are falling and the news is getting worse by the day? Well, for a lot of investors, the honest answer is nothing. Now, I know that's easier said than done, but here's the most important thing to understand about a falling market, and it's something that often gets lost in panic. You only actually lose money if you sell. When your portfolio drops in value, what you're looking at is what's called a paper loss. It's real in the sense that your balance is lower, but it only becomes a real locked-in loss the moment you sell. Till then, it's just a number on the screen. Now, you might be thinking, but what if it keeps dropping? Shouldn't I get out now and cut my losses? Well, that's a completely understandable instinct. But if we look at history, it might not be the right course of action. Because during previous periods of conflict and uncertainty, like the Gulf War, the dot-com crash, the 2008 financial crisis, or even COVID, markets did take a battering. But in each case, they picked themselves up and went to rise again. Of course, not in a straight line and not without setbacks along the way. But the general direction over time has been up. So when the world feels out of control, that longer perspective can be genuinely grounding. And here's something else to consider. A lot of what we see during these moments is markets reacting to sentiment, to headlines, to speculation, and to fear. But over the long term, it's the underlying fundamentals that tend to matter more. Things like company earnings, economic growth, or innovation, which are all things that historically have given markets reason to perform, which in the end is why those investors who held their nerve and did absolutely nothing during precarious times were often the ones who came out the other side in the best shape. Well, let's say you do decide to move your money into cash and wait it out until things settle down, to then reinvest when the time feels right. Well, it sounds sensible, but there's a problem. Once you're out, you have to decide when to get back in again, and that is genuinely one of the hardest things to do in investing, even for professionals. With hindsight, it's easy. You can look at the market chart and point to the bottom and say that the perfect moment to brought back in and ridden the recovery all the way up was that day of the month. But in the moment, where the news is still bad, the headline's still scary, and nothing feels certain yet, almost no one gets that call right. Not even the fund managers with teams of analysts, decades of experience, and the best technology money can buy. The reason is the markets are very unpredictable in the short term, and no one can truly know how they'll move on a certain day or a certain week. And that's relevant to us because the cost of getting it wrong is higher than most people realize. Because here's what the data consistently shows. Take the S&P 500 between July 2005 and June 2025, 20 years that included the financial crisis, COVID, and plenty of other bumps along the way. Well, if you stayed fully invested the entire time, $10,000 would have grown to $66,737. But if you missed just the 10 best days over those 20 years, your $10,000 would only be worth $29,690, which is less than half. If you missed 20 of the best days, you'd be down to $17,530. If you missed 60 of the best days, your $10,000 would actually be worth $4,121, which means you'd have lost money over 20 years in a market that went up. But here's the part that really brings it home. 7 of those 10 best days occurred within 2 weeks of the 10 worst days. And the second worst day of 2020, March the 12th, when markets were in freefall during COVID, was immediately followed by the second best day of the entire year. So if you were sitting in cash trying to avoid the bad days, you will most certainly miss the best ones too. And all of this brings us back to the same conclusion. If you sell when markets fall, you don't just lock in your losses, you risk missing recovery too. Which is why, more often than not, doing nothing is the hardest but smartest move you can make. So, when tensions are rising and it feels like we could be on the brink of war, rather than trying to predict what markets will do next, perhaps it's better to focus on what we can actually control. And that basically comes down to 4 things. 1. Only invest money you don't need in the short term. This one is foundational. The general rule of thumb is don't invest money you'll need in the next 5 years. Because if you're not planning on selling anytime soon, short-term volatility matters much less. Yes, it's still uncomfortable watching your balance swing around, but you won't be forced to sell at the worst possible moment. And this is exactly why having a cash emergency fund in place before you start investing is so important. When you've got cash set aside for unexpected expenses or those inevitable moments when life doesn't go to plan, your investments can do their job, which is to grow over the long term without you needing to touch them. 2. Diversify. Now, this is the investment equivalent of not putting all your eggs in one basket, and it's particularly relevant during unpredictable times. When conflict or uncertainty hits, some companies, sectors and regions will hold up better than others, and some asset classes will struggle while others provide a cushion. This means that if your investments are spread across geographies, sectors and asset types, you're not over-reliant on any single thing to do all the work. And when some parts of your portfolio come under pressure, others can help balance it out. Now, diversifying can't eliminate volatility altogether, but it can make for a significantly smoother ride. And when the world feels out of control, that steadiness matters. And just so you know, this is something Moneyfarm thinks carefully about when building its managed portfolios, which are globally diversified across multiple asset classes with 7 different risk levels. So your portfolio reflects your goals and your personal comfort with risk, not just what's happening in the news cycle. 3. Stay disciplined. Times like these are a real test for investors, and often it's not the volatility itself that does the most damage to long-term returns, it's how investors react to it. That's why it helps to come back to basics, like your goals, your time horizon, and the plan you put in place before any of this started. Staying disciplined and sticking to that plan, however uncomfortable it might feel in the thick of it, rather than reacting to the noise around you, is one of the most reliable hallmarks of successful long-term investing. And 4. Keep a sense of perspective. No one knows what happens next, and as with everything, things could escalate or stabilize, and markets might recover quickly or they might remain choppy for a while. But even when world events are as unsettling as this, the fundamentals of investing don't change. So have a clear plan, diversify, stay disciplined, and give your investments the time they need to grow. And there you have it. Everything you need to know to navigate times of uncertainty when it comes to investing. If you found this video useful, please subscribe to the channel and have a look at the description below for more information on Moneyfarm. And as always, I look forward to seeing you in the next video. Bye bye for now.